Good afternoon, everyone. I'm Charles Payne, and this is Making Money. All right, so yesterday marked two notable anniversaries, right? You heard about it, you talked about it. The dot-com bubble, it peaked 25 years ago, right before that dazzling decline. I mean, really, it was a crazy decline. Think about this. The NASDAQ 100, it took a decade and a half for it to totally recover. And then also 5 years ago, the anniversary of the COVID-19 bottom. Look at this. So the results of that, it was the fastest bear market in history. It was also the fastest recovery in history. So during these rough patches like we've had in the last few weeks, we might think about this, we might think about that. I'm sure investors have contemplated both. And I got to tell you, so far, it looks like the lesson they've learned from the most recent past is really what's helped them. And they've ignored the financial media. And they've ignored the experts. Check this out. Retail traders have plowed $67 billion into this market as the experts were pulling money out. Now, coming into the month, by the way, equity risk premium suggested this market could actually go higher. Just look at the end here of the bar. S&P near 6,000. What's interesting about this is ERP. This is what the experts normally use. They normally love a guy like this, but instead for them, narrative seems to matter more, which I got to be honest, sounds like a rookie mistake to me. Meanwhile, JP Morgan, their trading desk, is suggesting that the EU exceptionalism trade, take all your money out of America and put it over there. They say it may be over. The valuation gap is closed, that there's a lot less selling of U.S. tech. The extreme optimism here has faded. And they've got some other reasons for saying it, but wow, that was pretty quick. I will tell you this. Today's session has been compelling. I know we traded in a very narrow range, but I want you to take a look at this, right? The sectors that are in the green, these are usually sectors that do pretty well, either cyclical sectors or, of course, the growth names. And this is really what's important because you've got the staples, you've got healthcare, you've got real estate, and look at that big move in utilities on the downside. Those are all considered safe havens. And also this market being just slightly higher is compelling to me because a lot of so-called soft data came out actually a lot. They all missed. All the economic data missed this morning, Wall Street estimates, and still we're hanging in there. So I want to bring up Bianco Research President Jim Bianco. And Jim, this showdown between the professional money managers and the so-called dumb money, let's just say we use the year in S&P as a gauge. Who's going to win?
Oh, I have a feeling that the dumb money might win because professional guys are overdoing it right now. We're talking about there's a great degree of uncertainty, and there's an uncertainty index that some academics put together, which shows last week having the highest uncertainty in 40 years. Now, let me restate that, Charles. More uncertainty last week than the financial crisis, 9/11, or the COVID shutdown. I don't remember last week being that ominous than everything else. And then we're trying to justify it by calling it the end of U.S. exceptionalism. That's a 200-year-old term talking about the uniqueness of the United States. And so we're completely overdoing this type of, move. And that's why the dumb money, the retail money that just keeps plowing into the market, I think is probably going to get more rewarded than all of these people that are chasing whatever the new exceptionalism is, whether it's Europe or the United States or somewhere else.
Yeah, it's been boggling to me. But here's the thing, and if we're going to be honest, right? Some people are rooting against the market and market and Tesla, right? And for political reasons. And I saw where you made a really great post yesterday, somewhat about Tim Walz, the governor of Minnesota, who actually had a lot of fun at the expense of Tesla, but he may inadvertently called the bottom also on that stock.
Yeah, never take your advice from somebody that owns no stocks. And that's basically what Tim Walz is. And, in that he was rooting for this stock to go down. Well, he did it. Usually people that own no stock that start rooting for it to go down or go up are usually when the move is over. And that's exactly what happened, too, when he said 225 and going lower. That was the exact moment it bottomed. And it's up nearly 30% since he said that. It's been an extraordinary turnaround in the stock.
By the way, I got a chart here I want to share with the audience because a few days ago, the DAX moved ahead of the Mag 7. And this gets back to the point that you were making, right? Like somehow here marked a transition where Germany, where they've got so many mistakes, you can't even begin to name them all. A lot of Wall Street money going there chasing the spending, right? They broke their the so-called debt break. They're going to spend a bunch of money, which they should have been spending a long time ago. But that's not true organic growth. I mean, say what you will for the Mag 7. The growth has been organic. You could say it's gotten ahead of itself. But I just, when I see this, it's fine if you're a trader, but it doesn't mean that we're no longer exceptional.
Yeah, exactly. And I will say one thing in defense of Germany. It's a very cheap stock market, but it's cheap for a reason because they've made a lot of mistakes in the last couple of years and investors have abandoned them and they've gotten down to dirt cheap levels. And there's an old adage on Wall Street that if you buy a bad market or a bad company that goes to just below average, you can make a lot of money with it. And that seems to be what's happening with Germany. And I completely agree with you. The government throwing money at a stimulus package by deficit spending, all right, it'll push the market up for a while, but it won't be a sustained rally. Now, maybe that's the start of something that Germany can turn around and do something a little bit more sustained with.
Yeah.
But for the moment, it looks like it's more like it's just such a cheap stock and it's finally getting some kind of traction. So, yeah, it's fine that it's rallying, but this is not the type of thing that's going to give it a multi-year advance.
Yeah, the political parties there that have the most momentum probably will get enough in the next election that they'll even erase this move. But before I let you go, thoughts on the Federal Reserve? Are they in play this year at all?
The next meeting is the most important meeting. If on May 7th, the Federal Reserve does not cut rates, after the 10% correction, the end of U.S. exceptionalism, the hyperventilation about tariffs, if they can't find a reason to cut on May 7th, they're not going to find a reason to cut on May 7th, and that the cut cycle actually ended in December. I don't think they will find a reason. So I'll say yes to your question. They are not in play. They're going to be on hold for most of the year.
Sounds good. Hey, Jim, always great catching up with you. Thank you so much, my friend.
Thank you.
So my next guest